Hello and welcome to Financial Revelations. I am David Safransky, your host, and you could follow me on Twitter at skibucks, the number one, skibucks, the number one. I do look at Twitter frequently. I like Twitter for financial news because you can subscribe to a lot of different websites, and a lot of them break financial news there first because it's considered a public forum. And so if they want to avoid breaking a law on insider trading, they can break it there, and it's considered disseminated. So I like Twitter. You can follow that. We do put some stuff up there from time to time. You can also email us if you have a question, a comment, a need, anything you want to talk about. You can email Joshua at EP46.com. And if you want us to address a topic that you're interested in we haven't spoken about, I'd encourage you to send Josh an email, and we'll probably do the topic. So I always like to hear from people who are watching and see what they're interested in. What are you interested in? Because when you're in this business, you tend to think you know what people are interested in, and quite frankly, I'm always surprised by some of the questions that we get. They're good questions, but it hadn't occurred to me to answer those questions, so I'd love to hear from people. Where I want to start today, we've been out for a little bit because my production staff had COVID, and they were out, so we were out. I want you to remember back a little bit, about a year and a half or so, January 1st, 2021. January 1st, 2021. I'm sure you remember where you were at. Well, it was New Year's Day, so you're probably at home. Gas was $2.39 a gallon was the national average. The national average, $2.39. Today, as I drove to my office, there's a gas station. It's a Get-Go. $4.74 a gallon, $4.74. Inflation is at a 40-year high. And you think 40 years or more we haven't seen this level of inflation. The Fed is very active in the market. They're going to do 50 basis point rise in June, a 50 basis point rise in July. And then my guess is 25 basis points for the rest of the year. There's no meeting in August, but they can do a rate hike without a meeting. They don't need a meeting. They could do a roll call, a voice vote. They've done it before, and they can do that. And I think they probably will do that. I don't see any reason for them to take a pause in August with rate hikes because, quite frankly, if they don't get this ball rolling a little bit quicker, inflation, and it's already out of control in a lot of ways. There's no doubt about that, just in fuel prices. But that's a man-made disaster. But when you think about, for instance, diesel fuel has doubled in price this year. So if you're an over-the-road truck driver, you're driving on the highway, you see one of those semis come up beside you or behind you, or you're passing them. Look at those gas tanks. Think of how much diesel it takes to get that thing moving and to keep it moving across the country. These are very expensive things, and this is one of the reasons why inflation is so high, because everything that we do gets delivered somehow to the store, whether it's truck, train, plane, automobile. It's all getting there, and it's all getting there way more expensive than it was just a year ago, and significantly more expensive than a year and a half ago. So that being said, I don't really see inflation probably peaking until we find a way to get fuel prices down. And the administration isn't really trying to get fuel prices down. If they were, we'd be drilling here because we were energy independent 2 years ago. We were shipping energy out. Oil that we were in excess of. Natural gas, we could be sending that to Europe, taking the place of Russian natural gas, but we're not doing that because we just pulled the permits on 2 liquefied natural gas ports that would have sent LNG over to Europe and other places, but Europe is a big place for it. And these ships carry tremendous amounts of natural gas. It's liquefied, offload it, reconstitute it. It's natural gas again. Natural gas in England is 1,000% higher than a year ago. It's costing people so much to heat their homes. And wait till air conditioning season. It's going to be, it's been hot here a couple of days. It's cool today, but those couple of days that were hot, when I turned that air conditioning on, I thought about what the bill was going to be. And I'm going to do it no matter what. But people who are living on the margin, they're probably not going to do that. The market is way off the highs. Moms and dads can't get baby formula. I don't know if that's ever happened before, that we have a baby formula shortage. We really don't deal with food shortages in most places in the world. We just don't. We have way more food than we've ever had before, mainly because of modern agriculture and fertilizers created through fossil fuels, by the way. So what do we, there is one place where there's a food shortage right now, and that is in Venezuela, where some people are starving. But that's by design of the government. The government is doing that to their people in certain areas. And on top of all that, Russia is still pounding Ukraine and taking territory. We're not seeing it on every headline like we were when the invasion first started. But Russia is just methodically chipping away. And yes, we're sending a lot of weapons and a lot of money, as are a lot of other countries. But Russia, their conventional forces, while I think them attacking Ukraine was quite a tell on the status of Russian forces. They're just not ready for prime time. But they're taking on a small force, a significantly smaller force in Ukraine. And so they're just sheer numbers, they're going to probably take whatever they want unless we do something else, which we might do. Now, the good news is I did get 2 new puppies, Penny and Pixie. They're adjusting well. They've been with us for about a week. Lydia, our current dog, is adjusting slowly. She's over there in the corner. You might hear her breathing. She's kind of some people would think she's a baby rhino if you just heard her breathing. But there's been some dislocation for Lydia, but I think she's starting to get used to things. So it's all going to be okay. So given all these things that we've talked about or I've mentioned right now, here's how I want to focus portfolios right now and the way that I want you to think about investing and what's going on in the market. When the Fed gets involved and costs go up, so what they're doing is they're raising the cost of money. They're raising interest rates. You're going to see the housing market probably start to slow fairly significantly towards the end of summer, I would imagine, because it takes about 3 to 6 months for a Fed rate hike to really filter through the economy. And they've only done 75 basis points so far. Now, the 30-year fixed mortgage is above 5% for the first time in a while. That's going to slow things down. But as of right now, people are switching from fixed mortgages to variable rate mortgages, and they're still buying because those rates are still pretty low. And those are going to go higher also naturally. But I want us to focus on really more cash flow. Usually larger companies, established companies that pay a dividend, and essentially they're paying us to wait. So I'm not telling you to buy this company, but companies like a Home Depot or a Microsoft or somebody like that, they've been around for a long time. They have great scale. And one of the things about like a Home Depot or a Lowe's or somebody like that is if people are buying new houses, they're going to Home Depot and Lowe's because they're going to change curtains, they're going to put in new flooring and do things like that. Now, if mortgages get really expensive and the housing market cools, people who would have previously sold their house looking for an upgrade, now they're going to stay and they're going to upgrade that house because these things tend to cycle over long periods of time. So the mortgage rates stayed low for an extended period of time, and they're probably going to stay higher for an extended period of time also, or just back to normal. A 2.5% mortgage rate is not a normal rate. It's abnormally low. So as mortgage rates go up, people say, well, I'm not going to trade this low mortgage or a paid off house for a high mortgage because they're so used to low mortgages. So they stay and they fix up that house. And now they're going to Home Depot and Lowe's to do the same thing they would have done had they bought a new house. So they tend to win in both scenarios. Now, if the Fed does raise rates excessively high, and they have talked about going above neutral, and when they talk about neutral, what they're talking about, the Federal Reserve, is they're saying we want to take the rate, and the Fed funds rate, and match it to the inflation rate. So if they think inflation's at 5, the Fed funds rate's going to 5. Well, they're saying, well, we might go a little bit above neutral. So if the inflation rate's at 5, which is way higher than that, but if it were to go to 5, then they'd go to 5.5 or 6 for a time just to slow things down. So that's what they're talking about. They could do that. We just need to see the data. And after every rate hike, there's some new data that comes out. Is the market slowing? The stock market way off the highs. What I don't want you to do is get panicked and sell. Don't solidify those losses, especially if it's good companies. Now, I do harvest some losses in companies that I think I'll be able to buy back within 31 days and buy them back relatively close to where I sold them. So I have done that, but we're looking to get back in, and we will get back in. And then I want you to look, what I do is I look for opportunity in the face of all this bad news. And by the way, not all the news is bad. There is an upside to the Fed raising rates. And one of the Fed upsides to raising rates is that the push and pull of investing kind of comes back, where once the bond market is back in play, meaning the rates are high enough where I could allocate some money to the bond market, that's exactly what I do. And if the 10-year Treasury, 10-year government bonds at 5%, usually a higher grade corporate bond would be somewhere around 6.5 or 7. And, I buy that, and I could hold on to it for 10 years and get 6.5 or 7%, or I could sell it early if it made sense to do that. So there is this natural push and pull in between the stock and the bond market when rates are appropriately priced. And that's what we're getting back to. So it's not all bad news. It is bad news for companies that are highly levered and banks want their money back, and so they have to go out and refinance at a much higher price. For them, it's bad news. And a lot of those companies are getting punished. You look at companies that really excelled during the pandemic, like Peloton and Zoom and Netflix. They have really been punished in the last 4 months. So that will continue because rates are going higher. So what I want to do is I want to look for the upside wherever we can. I want to look for the opportunity wherever we can. And even in really bad markets, there's a lot of opportunities. So some companies, some really good companies, get dragged down along with everybody else. And those are the companies that I want to look at. So I want to look at great companies, really great companies, on really bad news. That intrigues me. The other thing that I'm doing is I'm kind of staying away from Europe right now because I think that Ukraine and Russia and the energy supply there, that's going to be something that's going to take years to get worked out, and they're going to be punished for that over time. Their costs to do everything that they're doing now are just going to go up, and it's going to hurt profits of companies over there. So I'm not really interested in Europe right now. Now, listen, if you have questions, if you have comments, if you just want to run a question by us, you can always call us. You can email us. I want you to know that we don't necessarily have skin in the game. You don't have to work with us as your financial advisor to ask us a question. If you just want somebody to take a look at something that you're doing or you have been presented with, there's a chance that we could do that. So don't waste this resource, and that's what I think of us as. This is a resource for you, the listener, the watcher. Use it. Ask your questions. Get your questions answered. We'd love to do that. And we're going to do an episode a week. That's what we're trying to do here, unless somebody has COVID and can't produce it. But that's probably not going to happen for at least another 6 months or until the next vaccine comes out. I'm going to talk about I'm not going to go into COVID in general, but I'm going to talk about some of the numbers around COVID and what's happening and how that's going to look through the end of the year next time, but especially how it affects us economically. So I am David Safransky, your host. This is Financial Revelations, and I will see you next week.